Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken, and our model portfolio is up 13.62% year to date. We now have a green for the stock market strength color signal. We do a simple portfolio here with 3 positions with either shares of the ETF SPY symbol, which is the S&P 500, or we do options, or we're in cash. Here's our current portfolio configuration. We start the year off with $100,000 and we build from there. We're currently up 13.62, and the S&P 500 buy and hold investor is up 19.90. Here are some past returns of our model portfolio. Last week, the S&P 500 gained 0.83%. And I'm going to go through the charts in much greater detail later on in the presentation. But here on this weekly chart, you can see how we're in this trading channel and we just broke above, as far as last week's action goes, above this resistance line, this red line, which is from this high coming down to this top here, and then we just broke out above it. Last week we made a trade. We did roll out our 2 in-the-money call options. So we rolled them out from 12:15:23 to 2:16:24 to give us some more time. That was about a break even, so there was no cost for that trade. Here are some of the trades that I've made in 2023. If you want to see all my trades going back 3 years, you can head over to this link. It will be down in the description below. Everything that I'm presenting, there'll be links down below for you to explore on your own. We currently have 2 open positions, which are these 2 yellow cells. We currently hold 200 shares of SPY, and we purchased it at $4.43. It's currently at $4.59, so we've got a $3,000 profit there. But we do have some in-the-money calls, so the last one that I rolled out, we're showing a loss of negative $2,480, and the market continues to be strong. So we're currently, as of the end of Friday's action, down 844 on that call. But if this market begins to correct like I expect it to do, then this number will go positive, and we'll be able to close that out for hopefully flat money. And then we'll be able to take on more long positions. That's the goal. All right, here is the equity curve for the model portfolio for 2023 year to date. Here is the equity curve for the S&P 500 buy and hold investor year to date. And here are the 2 equity curves combined. Our model portfolio in blue, the S&P 500 buy and hold investor in pink. And I started taking a more conservative position in the portfolio on about 4 weeks ago, and that's why my portfolio has been slightly flat to up, whereas the S&P 500 has continued to be strong during this time. I was expecting a little bit of a pullback that never came. Here is the Fed Chair Jerome Powell, and here are some interest rate movements that we've made recently. The next announcement is in about a week and a half. December 13th, are we going to have a 25 basis point rate hike or skip? Now, on the presidential election cycle theory, we currently are in the 3rd year for President Biden's term, and that historically has averaged 16.3% for the S&P 500, and on the NASDAQ 100, that averages 32.27%. Now, the S&P buy and hold investor is currently up about 20%, so we are about 4% heavy on compared to the historical norm. So there's room for this market to correct 4% and still be within the historical average between now and the end of calendar year 2023. Now we're looking at things from the bond market, and we still have a negative inverted yield curve. We are still having rising interest rates. So all of these things combined are bearish for equity investors, stock market investors. Now we're looking at things from valuation from two different sources. One of them is from CMV. The link is here and in the description down below. They're saying we are overvalued by 39.3% on a PE ratio. And here, another stock market service called VectorVest, they say that the S&P 500 is currently at value. They do have a buy recommendation. It has fair safety, very good timing because the market has been so strong recently. The overall rating is good, but the upside potential is fair. Now we're looking at CNN Business Fear and Greed Index. Here is our friend Warren Buffett, the Oracle of Omaha. And we currently are in greed, getting close to extreme greed. Now we're looking at things from a seasonality standpoint. We are in the month of December. This seasonality chart is going back 20 years, month of December. 70% probability that we're going to close higher than when we opened. And the month just started off, so this is all brand new. So for the month, the S&P is up 0.59%. Historically, we average 7.52, and on the best average for 10 years, the market was up 10.41%. Well, the market is currently up about 20%, leaving plenty of room for this market to come down and still be within the historical average returns for the S&P 500. Now we are looking at things from a long-term outlook. This is a monthly chart going back 20 years for the S&P 500, symbol SPY, bull market. Right here, downward trading channel broke out, and we are in a bullish stance as long as we stay above this line here, this support line here, and as long as this MACD stays positive right there. And it is positive right now. So from a long-term outlook, we're bullish. Now we're looking at things from an intermediate term outlook. We're going back 5 years. Weekly chart. Last week we went up 0.83%. We are in a new trading range because we just broke this resistance line. Now it's going to act as support. And until we break out of this new trading range, we are in this new trading range from the old highs here to this line here, somewhere in this level here. It's about 3.5% variance. The MACD does look positive. It is positive. So this is looking bullish, I should say, and slow stochastics as well. So it looks like we could stay in this range. We could even come and hit that overall high right there. Now we're looking at a short-term outlook. We're going back 6 months on a daily chart for the S&P. Candlestick chart, each candlestick represents 1 day's worth of action. Now here's where I rolled out my in-the-money covered call on this red candle right here to give me some more time because I'm expecting a pullback. I did put in Fibonacci retracements here. So starting up at grabbing it from the bottom here to the current high that we're at right now. So if we do a 38% retracement, that would take us to this level. 50% is here, and 61.8% is here. I'm hoping that we get to this red arrow right here, because there's a gap fill right there. So there's a gap here, there's a gap here, and there's a gap here. Yeah, I'll show you in a little bit where my buy zone is, but I'll tell you right now, it's right about here. Anywhere in here, I'm going to end up buying to close my in-the-money covered calls and probably take on some long calls, and because this market is looking strong. It's just that this angle of ascent was too vertical and it was unsustainable. As we've already pulled out of it, we're already moving sideways. The histogram is already showing that it's lost momentum. You can see here on the MACD that we've come down, but we're still above the signal line, so it hasn't crossed below it here on this daily chart yet. Okay, now I want to show you looking at this chart for the S&P 500, and this is a daily chart. And what I did was the MACD, which is this section down here, we are at this high that you see right there, and I put in a horizontal line this way, right touching the current high. Then where the past highs were. Now I looked at this chart going back 20 years. This has only had touches within the last 4 years. So I've grabbed the last 4 years of data and then put in these vertical lines every time that the MACD was at the same high that it is currently at, going back 4 years, but keep in mind that I did review this going back 20 years. Now, every time that we've hit these MACD elevation levels at this point, which is about 6.933, starting here at this oldest one, we had a 8.3% correction. This one over here had a 9.67% correction. This one here was a mild correction, only coming down 3.2%. This one here, taking it from here to here, that was a correction of 4.7%. This one, now that actually I didn't even count that one. This one here, oh, that was a severe correction, 18%. This one here took you from here to here, 7.25%. This one here took you down 7.63%. This one here was a small correction, just from here to here, 1.81%. And then further on down the road, this one, just taking it to this point here, 4.77. But it did ultimately end up dropping down here, 9.8%, 9.86%. So the majority of the times when the MACD is at this level, you are dropping anywhere from 1.87% to at least 10%. So odds favor that we are going to pull back at between 2 and 10% from our current position. So that is one of the pieces of evidence that I'm basing my decision off of, that we have some level of correction in our near future. Okay, now we are looking at a ratio chart of the NASDAQ 100 compared to the S&P 500. The red and black line is the ratio chart. Normally in bull markets, you want the NASDAQ tech-heavy risk-on market to be leading the more conservative S&P 500. Currently, which is this red line here, because the ratio chart is the one that's in red and black, is heading south, meaning that people are taking the chips off the table on the NASDAQ 100 and putting them into the more conservative S&P 500. Generally, that it's a risk-off indicator when your ratio chart is heading down. Also, you can see that the MACD heading down, slow stochastics heading down. All of these things suggest that the market is wanting to take some risk out. Now we are looking at another ratio chart, but this time it's the equally weighted RSP symbol against the normally cap-weighted S&P 500 symbol SPY. The ratio chart, again in black and red, has fallen off of a cliff and it has begun to move sideways. This is a weekly chart, by the way, so it's slow compared to a daily chart. The last 2 times in the last 20 years that the ratio chart fell off the cliff like it recently has, we've had sideways action going back months of sideways back and forth before finally breaking out and beginning that new bull run. This new bull run is where the safe money is going to be made. We're not at the safe money yet. We still have months to go for all of this to play out, possibly even after the 2024 election. In 2025, I would not be surprised where that's where the safe money is to be held. So between now and 2025, you do not want to lose your money. My plan is to try to make some safe money. I'll be very happy with my 13 to 14% returns with the equity curves that I have for the next year. and then when this new bull market comes on, lay on more leverage, and we will make some serious bankroll during that time. Personally, I don't think we're there yet, and I would hate to be long with heavy leverage and experience this drop off. The S&P 500 is in dark blue. This drop off or this waterfall decline here. We do not want to be caught with our pants down in that situation, and that has not happened yet. Will it happen? The market, as it shows us today, it's not ready to happen, but it certainly could happen, and it has happened twice in the last 20 years when the ratio chart does this. Now we're looking at the fear index. We are in the ultra low range, rock bottom lows. Look at the MACD and the histogram of the MACD. These suggest that the market is, that the VIX is getting ready to jump up. When that jumps up, this is going to jump down. Now we're looking at the Thinkorswim platform 1-year chart for the S&P 500 daily chart with standard deviations. +2, -2 in gold, +1, -1 in pink. Here's some information about standard deviations. We are currently at 0.3 standard deviation on the 1-year chart. And I drew in a trend line here to show you that old high here. We're at a double top formation right now. Now I'm showing you the same thing, but instead of going back 1 year, it's going back 6 months. You'll notice that the standard deviation lines going back 6 months are somewhat flat to negative. And currently on this 6-month chart, we are at the +2. We are technically at 1.9, plus 1.9 standard deviation. Well, we know that 95% of the time you're going to trade between the +2 and -2, and so that's why I've got in here sell zone. This is the position that I have taken with my in the money covered call. I'm not taking any, I didn't buy any puts or anything like that. I'm not going that drastic, but I did go as drastic as to buy an in the money put. Now I did buy it too prematurely, in the money covered call. I did buy it prematurely. At this arrow here on this date is when I started my in the money covered call, and I should not have done that. I should not have placed it. The very next day the market jumped and it hasn't looked back since. So now that we're at the +2, I am expecting somewhat of a pull down. If we get into this zone, this labeled buy zone, I will take my in the money covered call, buy to close it, and then potentially take on some more longs. See this old high? By the way, you can see I've got an alert set up here. If the market comes down to 436.96, I'm going to get an alert on my cell phone. At that point in time, we're going to be kissing this which was once, this is your low, your high, your low. This was a high that was developed, and that found resistance before coming down to support. Well, now that we've broken out above it, this is going to act as support, which once was resistance will now act as support. It would be perfect for it to come down, come to this area here, and then reach some support, which is right in the middle of my Fibonacci retracements that I showed you on an earlier slide. And then there'll be some level of support in here. We may even get a gap fill all the way as low as this point, possibly, who knows, but I'm just trying to show you where my head is at. Now, here is my market strength indicator, and here is for asset classes, and here is for the 11 S&P sectors. Now, I have changed my algorithm or my calculations around. I was using 3-month chart, and now I've pushed that out to a 6-month chart. I've done research, and I've removed the 3-month chart from this presentation. The 3-month chart was, especially with the standard deviations, was throwing me off, and you're going to have more accurate data going out with a minimum of a 6-month time frame for the strategy that is implemented for this portfolio. I've also changed around the algorithm here. Instead of going from 0 to 50 and then 51% green, I changed it to a little bit more conservative. So 61 or higher is a green. Well, guess what? We are at 65% with this current algorithm. Last week we were at 56. Well, that puts us from yellow to green for the S&P 500 11 sectors, showing strength across more of the sectors. Now, this one up here is just for asset classes to show you where where the world is amongst different things, just to see how the strength of everything is going. Here we're at a yellow, and we are at 58%, and at 61% we're going to be a green. So we're very close to a green signal with this chart. Now we are looking at the 10-year US Treasury yields, and that one is the candlestick. You can see that there was a gap here. I'm still expecting that gap to get filled. It's been in a downward trajectory channel, and here's the S&P 500 in dark blue. When this goes down, the S&P 500 goes up. So if this starts to bounce, which it possibly could at these support levels right here, and look at your MACD, it's coming down into a way undervalued area here, way below the zero line. Now, it hasn't shown signs of correcting yet, but we're getting to a low point here where I'm expecting somewhat of a bottom. This is going back 1 year. So there's only been 2 times in the last 1 year that it's come down this low. And here, when it came down that low, it jumped up. And let's see, over here, you can see you've got a bounce right there. So I'm expecting somewhat of a bounce and maybe even a gap fill all the way to 48. So I just gave you a ton of information in this video. Now comes the critical thinking. What are you going to do with all that information? Here is what I'm going to do. As of December 2nd, 2023, the market summation, according to me, Ken, your friendly host with SPY Trader Now, on Wednesday, 11/29/23, I rolled out my in-the-money covered calls. I rolled them out and up, so that because the market is going up. So I'm correcting. When I did that for about a break-even cost. Didn't really cost me anything. I did it for no money. I wanted to buy myself more time because the market isn't correcting yet. And I'm expecting downward to sideways action over the next week or so, as I presented to you during this presentation. After doing more research, I decided the 3-month chart is not productive with the standard deviation lines, and I've removed them from this whole presentation. So I'm not going to be presenting 3-month charts because they're not good. They even threw me off, and that's why with that particular chart, that was the one and the reason why I exited and went into that in the money covered call the way that I did. I was premature. You can clearly see that with the presentation. I showed you on the arrows. I was early to the party. I should have held out. I should have held it in there. But right now on the 6-month chart with the +2 standard deviation, I believe we are there. So I'm maintaining my position. So furthermore, I changed the calculation on the sector strength meter, which I showed you. We do want to go long this market, but we don't want to enter more longs at this +2 standard deviation on the 6-month chart. So my plan is to buy to close the in-the-money covered call positions when SPY reaches some level of support at the regression line or below. I showed you my buy zone. The regression line is that dashed green line on the standard deviation chart. So this market is showing very strong action, and it's broadening out to more sectors, which I showed you on my strength chart. So we're in a good position. We're still in a fine position. We're holding $17,000 in cash in our model portfolio. Our model portfolio is up 13.62% year to date, as you can see right here. Yes, we're not beating the returns of the S&P 500 for calendar year 2023. And quite honestly, I don't think we're going to. But even though I didn't beat the returns of the buy and hold investor, is that terrible? I'm still getting a return of almost 14% year to date with this equity curve. Certainly better than money market returns. So we do have some level of market risk and all of that, but it's not a bad return on investment for a conservative portfolio. I hope you got some valuable information out of this video. If you have not done so already, hit that subscribe button, ring that bell, and help me and smash that like button down right now. I thank you and I wish you good trading.